Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. Today we will focus on multi-asset mandates in the form of a panel discussion with three top fund managers joining me here live on the session. We'll try to keep the session as interactive as possible. You all know the story. There's a Q&A bubble. So as we progress, you're more than welcome to post your questions, whatever questions you have as part of a conversation, and we can try to work it in or cover that as best possible. It is my absolute pleasure to welcome our three panelists for the morning. And I'll start with Walter Jacobs from Blue Alpha Investment Management, Paul Bosman from Granite Asset Management, and Peter Little from Anchor Capital. Good morning, gents. How are you keeping this morning?
Morning, Eugene.
Really good. Thanks, Eugene.
We are going to talk a little bit about Africa as well, and perhaps not Africa Sky Blues as the song that Olga played, but we'll get to that in a bit. We will mainly focus on multi-asset high equity mandates, or better known as balanced funds, to the audience out there. We will make reference to some other flexible multi-asset mandates that the managers manage where appropriate. But let's get right into it. We've got a tremendous amount of ground to cover. And I'm sure lots of questions from the audience as well. But let's start by getting more insight, and I think it's a good starting point to investment approach and philosophy. And Walter, if I can maybe start with you. And it's exactly that. I mean, where do you start when constructing a multi-asset portfolio? Does strategic asset allocation impact on performance of a fund if conventional wisdom have it that asset allocation is the driver of all returns?
Morning, Eugene. Yes, thanks for that. Yeah, perhaps stepping back a bit. So Blue Alpha has been managing multi-asset funds since 2004. And we also have the Blue Alpha Balanced Fund, which is a Reg 28 fund. And obviously, Reg 28 will dictate what your asset allocation at the maximum and minimum levels can look like. So we believe in strategic asset allocation, and that means that the allocation to the asset classes remain fairly fixed. So global equity, we run pretty much close to the maximum allowable level, 45%, and then local equity will make up 30% to give you the max 75% exposure that you're allowed in the multi-asset high category and also per Reg 28. And then, some property at 10%. So 85% of our balance fund is basically in growth assets. And that portion remains fairly fixed. Now, why would that be? You've just mentioned lots of research will show that asset class selection is a major contributor to returns, and so recent research would say that the way that they looked at that in the past was maybe not 100% accurate. So there is nuances to that. So you have to look at the active bets that you're taking relative to that, and also it assumes that you're making the correct decision every time. Now, if you just look at the balanced fund performance of Blue Alpha over 5 years, it's sitting at 9.7%, 9.8%. It's ranked in the first quartile. It's ranked 26 of the peer group per MoneyWeb. So you can achieve very good performance by sticking with strategic asset allocation, meaning that you don't have to chop and change all the time. The other thing that I'll say is equities has actually got so many possibilities. You often hear markets talk about bond proxies. So, if I'm looking for stable income that looks like a bond, I can actually find that in equities. Plus, I can find all the growth that probably a bond can't get you. Yes, that might be slightly more volatile in the long term, but the outcome could be the same or actually better, because research also shows that over the long run, equities is the best performing asset class. And so being in equities and also not missing the best days in the market, those all contribute to returns. Otherwise, and that's equities is our strength. We've been managing equity, both local and global, for a very long time.
A lot of information in that, Walter, and we're going to unpack a lot of that a little bit more as we progress, especially your views on equity. But before we do that, Peter, if I look at the Anchor BCI Managed Fund, your official benchmark is the peer group average, but I know you do target a real return of 4%, and we can maybe talk a little bit more about that if you want. But what I'm more after is similar, being a fundamental house, how do you get to your strategic asset allocation given the return objective?
Hey, thanks, Eugene. Yeah, so similar to what Walter said, I mean, there's a hell of a lot of very smart people who have dedicated their lives to researching these things, and we're obviously consumers of that stuff. And easy for us to buy into the idea that over the long run, asset classes will have certain return profiles. Equities are going to grow. Companies are going to grow their top line at real GDP. They're going to grow their expenses at inflation, and that will give them, assuming positive real GDP, will give them some operating leverage, and that will give you a number of, depending on the country you're looking at, somewhere around the high single or low double-digit return. So we know that that's what we can achieve in equities without, too much hard work. Fixed income instruments tend to, over the long run, give you a returns roughly equal to what their yield is, so we kind of know what those are, and then we try and combine those into a bucket, obviously cognizant of Reg 28 constraints, but combine those into a bucket that, as you say, is going to give our clients at least 4% of real asset growth. And we've got to remember that this is a financial advisor is plugging that equation into a long-term financial plan for a client that's trying to plan for retirement. So we want to have that as our base case, and combining the assets and in a certain way gives us confidence that over the long run we can get there. Similar to what Walter said, we got to have a reasonable amount of growth assets in there. I think we're targeting somewhere around 70% across equities and property, both domestically and globally, and that should give you a decent real return. South African fixed income markets give you certainly over the long term a real return as well. And then there's two ways to enhance that. I think you can kind of tactically move around and take advantage of mispricing in various asset classes or perceived mispricing in asset classes. That I would say we're cognizant of it, and we've just published a report, which we do on a quarterly basis, suggesting where we think the asset classes are priced, or what their prospects are over the short term. But I think we're also an equity-centric house. We like analyzing companies, and we think that our competitive advantage is in identifying companies that can grow above that sort of high single-digit, low double-digit return base. So that's where we're trying to add alpha, but we want to make sure that we combine those assets strategically in a way that sort of our long-term base case gets us to at least a 4% real return over time.
Sensible, skillful time in the market. And Walter, I think you did mention that as well. Your fund performance, a lot of clients ask that, can typical balanced funds still get that return objective of inflation plus 4 to 5? And the answer is yes, you can. Peter, thank you very much for that. I want to dive a little bit more into your tactical asset allocation views in a bit. But before we do that, Paul, with Granite, your starting point is very different. You don't have a strategic asset allocation view, and I'm still trying to get my mind around that in terms of, where do you start then when you build the Granite BCI Balanced Fund, and to some extent the Flexible Fund? How do you do that? The red button. There we go.
It's actually not red, it's black, but Eugene, that's there are many things I shouldn't do in public, and one of them is dancing. And I found that good dancers can sort of listen to the music and then dance consistently with that. So I've got sort of 3 moves and I do them over and over, regardless of the beat. And I found that over time, portfolio construction is very similar. You've got to really be cognizant of what's happening around you, observe the reality, and then invest accordingly. And for us, we're going to move according to where we're finding those opportunities at that moment. And the end result will be asset location. There's a very important overarching principle, and I think that's what you touched on earlier, is don't try to time markets. So we won't have an overlay on saying we think the market is expensive and therefore we're not going to invest in this opportunity, or we think the market is cheap, therefore we're going to invest a lot more in this opportunity. It's always opportunity specific driven. We try and be very consistent with the reality rather than overlaying any view as to where market levels are.
Very interesting indeed. Peter, I want to come back to you, and I want to get a little bit more into those tactical asset allocation views. You did allude to your quarterly paper. I think it's called The Navigator. A very good read that. But I mean, let's look at more specific things. And a lot of in the news flow at the moment, things like SA elections around the corner. And there's so many opinions out there on which way it's going to go. I'm not a political analyst, and it depends on who you lend your ears to. The outcomes could be either very good or very bad. But nevertheless, I mean, we don't know which way it's going to go, and which polls do you believe? Who knows? But it all speaks to an extremely high level of uncertainty in the very short term. And adding insult to injury, I mean, we all know that the SA economy is in a slump. GDP figures came out lower than expected. Yes, the IMF numbers for the next year looks a bit more positive, but we'll see. Let's speak to things like SA equity. Now, if I look at that navigator of yours, your SA equity views are fairly bullish. If I look at your balance mandate, you're sitting at about 37% SA equity, slightly lower than global. Your global roughly at about 30%. And yes, SA equity is cheap, but it's maybe cheap for a reason. Why the bullish views on SA equity, given where we are?
Yeah, so that's a good question. I mean, you talked about all the things that we should be worried about, and obviously living in South Africa, we tend to take all those things very personally. So it's but through time, we would say that a lot of what happens to our markets is not necessarily a function of what's happening in South Africa, and rand weakness can often be the opposite side of the coin from dollar strength. But what we've seen in this first quarter particularly is South African assets which we're trading are reasonably cheap versus history, and we think that's probably fair because we are struggling to grow. We have structural problems. Our infrastructure is crumbling. That's a kind of a foot on the throat of growth, and so we're cognizant of all of those things. We think they were really probably baked into asset prices going into last year, and then what we've seen kind of heading into our elections now is that the rest of the world's assets have rallied for the first few months of this year, and South African assets have been absolutely hammered. And we think that at least part of that is a function of people or global investors at least protecting themselves against some sort of catastrophic outcome in our next elections. And so I think we're now at the point where we don't want to make a call on what's going to happen in the elections, but if it's anything short of catastrophic, we think the assets are way too cheap. So that's probably the main reason we're getting more constructive on South African assets at the moment. We just think that there's a hell of a lot of bad news baked in there. Again, we're not political commentators, but if we look at the 29 million registered voters and kind of do the math on how few of them have got to turn out and how many of them have got to switch allegiance to get to that sort of scenario where potentially you have some pretty, maybe coalitions that would scare international investors. We think that those scenarios, like quantitatively, are pretty improbable, and those scenarios we think are priced into the assets. So kind of we're getting more constructive, not because we think we're, you know, moving into Shangri-La and all our problems are solved and everything's going to be rosy again. We just think that it's overly pessimistic, and that's probably the main driver of our bullish stance on domestic assets at the moment.
Peter, I'm going to pop in a question here quickly from the audience while we're on SA equity. What is the correlation between SA economy and the commodity cycle, if any?
Well, correlation, that's a tricky one. I would say the correlation between the Chinese economy and the commodity sector is probably a much stronger one. And then we're kind of a second order effect. So when the Chinese economy is doing well and they're doing well from an infrastructure builder perspective, it's probably drives some economic growth in South Africa via, you know, positive terms of trade with exports and job creation. But I think the South African economy is kind of the price taker on that one. I think the Chinese economy is the one that's driving that cycle.
Interesting indeed, and we can maybe get back to China in a bit if we have time. Paul, let's stay with asset allocation views, but I want to touch on macro factors. Beginning of the year, we were all certain that we're going to see 3 rate cuts in 2024. Some said March, and then March came and said, no, it's pushed out to June. And if we listen to messages coming from the Fed recently, it sounds like rate cuts are probably going to come through much later in the year. And there was some possibility that maybe no cuts. You know, who knows? These are the kind of things you can't forecast. You can't simply bet on that. But factoring in macro conditions when allocating to growth assets, take us through some of your thinking. I mean, do you think about these things? Does it impact on your current thinking and your current positioning?
I mean, I think a personal learning through this whole latest interest rate cycle, from the low to the high to the higher for longer, is another lesson for me personally that I cannot forecast. I've been wrong on every single turn on this.
Exactly.
Fortunately, we don't actually make investment decisions on the back of forecasting. It's just not something we think we're very good at. But what we do try and work into all our investments is a normalization of interest rates. And we've done that for a long time. So interest rates can impact the valuations of your shares because the discount rate goes up. So we use through the cycle discount rate always, which is probably about consistent with where we are now if you took market discount rates. Then the balance sheet of the company you invest in, if interest rates stay high for longer and that debt rolls, it's maybe less of an issue in South Africa, but most of your foreign companies have got fixed debt, and then that rolls over time, so it reprices higher. And that impact in many cases hasn't hit yet. Because they're still running off the cheap debt, and that if interest rates don't come down and they hit with a higher rates, that could be quite detrimental for many companies. So we try and work out, is the balance sheet, if we roll it forward, are you going to be fine? Not only okay, we want companies that are going to be fine. So, you know, that's another important consideration for us. And another important consideration is if investing in companies that are growing fast at the moment, you're probably doing quite well. But you must hope that that growth rate is maintained. Because if your discount rate is higher and you get your growth slightly slower, there's a long way down. Because companies that can grow fast are still far more expensive. And if they keep growing fast, I think you're fine. But if you get your growth wrong, you can lose a lot of money here. So we try and, even on that, we try and invest where we've got a very high conviction on growth.
But I mean, there's this, by the sound of it, there's no rule of thumb. I mean, you can't blanketly paint growth assets based on macros. You've got to look at the balance sheets of companies and how it can potentially be impacted on the individual securities. Thanks for that, Paul. Walter, if I can maybe go back to you. You mentioned earlier on you fully invested, and by all means you are. If I look at the Blue Alpha BCI Balance Fund, as well as the All Seasons Fund, and the latter being in the SA Multi-Asset Flex category, so you still got a maximum of 45% global in both instances. But your total equity, excluding the property and balance, sitting at about 74%, Flex at 87%. So yes, you are fully invested. I mean, we can argue that there are probably more uncertainties in 2024 than 2023, because you just don't know. But why fully invested in current conditions with all these uncertainties?
Yeah, Eugene, I guess it goes back to our philosophy and observed long-term trends. Similar to what Paul says, is we don't forecast, we just observe current trends and try and understand where stocks fit in with current trends. So, you know, perhaps also touching on something that Peter said, you know, South Africa might not look screamingly attractive from a macro political environment at the moment. But if you delve deeper, I mean, there are some great opportunities here. Companies like Shoprite has been doing phenomenally well. You know, it's just take its 60/60 app. You know, to be able to do what they've done with 60/60, if you just think of the whole value chain, you know, you order on an app, it must integrate with your logistics, it must integrate at the store level, it must integrate with pricing. You place an order, it gets delivered within 60 minutes. So it's taking massive market share, and it's competing against two other major players that's facing serious difficulty. Pick n Pay, not generating any free cash flow, having to do big rights issue, potentially a big rights issue, Shoprite, Spar with problems in Poland, etc. So it's using its strong balance sheet, free cash flow generation to drive its growth going forward. And, you know, with its use of AI, you know, people like, again, Pick n Pay and Spar is going to find it really, really difficult to play catch up. Similar Capitec. I mean, we've just seen standout results from them. So you will find pockets of growth, and we're actually finding them. We're finding good pockets of quality growth that can be maintained for a long period of time. SA investors have got a love-hate relationship with Capitec. They somehow always think that there's problems down the road. And I've covered Capitec, you know, since I started in the market. And I mean, I was in asset management, I was on the sell side. And I can recall people telling me at 60 Rand, you know, Capitec was uninvestable. It was just way too expensive, and that it is got poor accounting, and actually that it's you know, that it's they're not confident in the books of the company. You know, you can't run a business for 10 years, 15 years, and not have those issues come out. So yeah, there's opportunities. You'll always find opportunities. Equity markets are massive. Lots of companies, locally and globally, enough to find those opportunities to remain invested.
And the skills to find that, obviously, as well. Paul, I know you also carry Capitec in your portfolios, and I don't want to get stuck into specific securities too much. But maybe other than Capitec, I mean, what other SA stocks really excite you?
Yeah, I think if you look, you know, if you look at South African portfolios, if you look at the African share portfolio that's decades old without being fiddled with too much, you'll find a few interesting results. The one is a share certificate that says Nasionale Beleggingsbeperk, and you wouldn't know what to do with that. You know, some people say it's got a lot of value because it controls Naspers, and other people say you can throw it away. So that's the first issue. But the second thing you're going to find is that the companies that were able to grow above the cost of capital in South Africa for a long period of time made people rich. The rest, if you were very lucky with your contrarian trading, you could have done pretty well, but that's not where the big money was made. So for us, our absolute priority is to find companies that can grow fast, and I think this is where we, you know, concur with Walter. Fortunately, as Peter says, South Africa is not expensive. Nothing is expensive. So you can find these really good companies at prices that if they were listed in the US, you'd pay, you know, double the multiple. So there are fantastic opportunities in the JSE, but there aren't many. I think that's probably the the thing. So something like Capitec and ShopRite for us, we really back the business models, we back the teams. We think the competition is probably weak. Companies like Afrimax, we're not big into resources at the moment. We think that's a management team that really understands return on capital. They're more investors in the commodity industry rather than what we think they're a commodity company. Companies like Udeco, they just quietly get on with what they're doing and grow at double digits normally. Coop Agri management teams really focused on return on capital. They're getting some nice growth coming through the business. Outsurance, we think, has got a model and the people who motivate it to grow. They're growing nicely. So there are a number of companies that really can grow, but the list isn't very long.
Pretty true on that. And Peter, I mean, coming over to you, I do buy your argument on SA equity being oversold, and adding comments to what Walter and Paul said as well, some really great opportunities there. But I mean, let's look a little bit at the global or the offshore allocation. And it's that ongoing debate, and we get a lot of questions from that, from the audience and from investors. You know, how much onshore, offshore? We know a lot of these mandates within Reg 28, so the cap at 45, so not too much room to maneuver. But if you look at global developed market equity at the moment, it is frothy, and some may even say it's expensive, but it all depends on what you look at and what you include and what you exclude. But given current global developed market valuations relative to SA, and a bit of a loaded question, if you consider a currency overlay, and given where the rand is at the moment, what do you do with your global equity component? Do you hold at 30? Do you bring more of that back? Do you add to that 30? Where are you on that?
Yeah, so I think we think of those two equity buckets slightly differently. So as both Paul and Walter alluded to, companies that can grow fast and certainly invest their capital wisely, that's pretty exciting for us as investors. I think that's pretty clear. And the sort of pot of opportunities to find those companies globally is extreme. There's a huge amount of innovation. We've gone through cycles of cloud computing where companies have grown their earnings incredibly fast in that space. Now we're looking at AI, again, opportunities for multi-year structural growth. Yeah. So for us, offshore equities are opportunities to find really well-run companies that are innovating and have multi-year, extremely high growth opportunities. So we don't want to get too. I would say stocks are globally in the DM at least are on the expensive end of where they trade historically. The S&P is probably at about a 420. It's certainly been more expensive than that, but it's not. So it's not crazy expensive. But yeah, we wouldn't get too caught up in trying to time our way in and out of these things. You can hold companies like Fortinet, an internet security company. That's it's maybe on the marginally expensive side of things, but we think that it'll grow its way out of that pretty quickly and getting sort of getting days out of the market, like Walter referred to, just because you're worried about the valuation, probably more costly in the long run. So that's kind of our offshore opportunity. Locally, we're looking for the opportunities that, again, Paul and Walter have talked to, like management teams that are innovating, that are often fighting in spaces where there's not much competition. We've got great entrepreneurs in South Africa, people who are used to fighting against adversity. I'm sure most of us are following this, the documentary on our World Cup rugby exploits. Like, these are kind of world-beating rugby players. We see that in a lot of the management teams, ShopRite, all of those guys. So that's what we're looking for in South Africa. Good management teams that are sort of operating in a low competitive space relative to what you would be doing offshore. They're great innovators. They're great fighters. So we think you can find that we're more excited about that in South Africa at the moment just because of the tailwind of really low valuations. But it's not like we're kind of going in and out of equities on that basis. We're just getting slightly incrementally more positive. So we probably would be adding to local equity on that basis. I wouldn't say we're trimming much on offshore equity, but we're not kind of getting over our skis on that one. And then the question that you pose on the currency, which is obviously once you buy offshore assets, that valuation in rand can be impacted by the currency. I think forecasting our currency certainly over the short to medium term is a bit of a mug's game. So we're definitely not in that camp, but we do sort of follow valuation models where we try and see whether things are under or overpriced at the moment. I think again because of a lot of what's happening with the US dollar and a little bit of what's happening with our upcoming election, our currency is probably on the cheaper end of where it should be. But that's never going to be a driving factor of taking money offshore and onshore. We tend to take a phased approach. We want to have a decent amount of offshore exposure through time to get exposure to those investment opportunities that you just can't find in South Africa. But we're cognizant that once you do that in a mandate like the managed fund, the currency volatility overlaid on top of that can get a bit messy. So we're not quite at the 45% level of offshore assets. We think sort of somewhere between 30 and 40 is probably the right number. Just from we're shooting for long-term returns for clients, but obviously clients are watching their returns month to month, and we don't want to add unnecessary currency volatility where we don't think that it's required to achieve those real growth of 4 or 5%. So currency probably on the cheaper end of that, but that's not driving a hell of a lot of our investment decisions, I would say.
And you're very right. I mean, if you think about currencies and forecasting, it's that makes me think of a song of Queen, "Mud on Your Face," and a big disgrace. So we don't steer away from forecasting. Walter, your global. We didn't speak about your global. You're fully on global as well. I know you've got strong views on global, X the Magnificent Seven, and yes, there's maybe a bit of FOMO there. But your take on global equity, I mean, exactly that question that everybody asks. Is it expensive? No, it's not expensive. But what's your view?
Yeah, Eugene, again, it's quite important to strip out the Magnificent Seven, I think. And the other thing to just understand is, we've spoken about it before. These expensive stocks have got certain expectations embedded, return on capital expectations and growth expectations. And clearly when you can't meet those growth expectations, as we've seen with Tesla, pre the run-up or pre this results announcements, you can get, hurt quite badly as far as stock price performance goes. And clearly Tesla has come back since the results because of their plans. But we don't own any Tesla. But we've recently run a screen on the US market, which everybody thinks is quite expensive, and looked for single-digit PE businesses that has a high return on capital, better than the average S&P growth for the next 12 to 24 months, and where analysts are upgrading earnings. And you'd be surprised how many stocks we actually found within these names. And a sector that came up pretty strongly is actually US home builders. And where we've been invested in US home builders for a while. So in our global equity fund, we own NVR, and in the balanced fund, we own Polter. So these were pre our screens, but there was actually 5 names that came up. And yes, maybe it's an interest rate cutting cycle or not, but these companies are very well managed, do a very high return on capital. US new home sales has been ticking up. And these companies have very strong balance sheets. So even if interest rates don't come down, they look really attractive. So you can find them. There's a few motor companies as well. That's not shooting the lights out in terms of cost of capital, but at least meeting their cost of capital over the cycle. That also looks pretty interesting.
Solid earnings, even amidst higher rates for longer, possibly. You know,
Yes.
so don't break your head on the higher rates argument. Look for those fundamental opportunities. A question from the audience from Pierre from BIP. Please can the managers comment on their current views on gold and gold miners, and including in their current exposures, you know, in your portfolios. Who wants to have a go at this, Peter?
Yeah, I can have a crack at that. Look, gold is not really our thing. I mean, it's when you're trying to value financial assets, we like cash flow underpins and things like that. So, you know, it's very hard for us fundamentally to value gold. And so you kind of got to judge supply and demand to figure out where it's going. So what we tend to do with those type of companies is try and look where you have a reasonable margin of safety. So earlier in this year, you know, the valuations were bombed out, the gold price had started to rise. We were actually, you know, thinking that there was a possibility that interest rates could come off. That's normally supportive for gold prices. And so we started buying them earlier in the year, just on that, you know, as I say, we tend to want to own them when you have a good margin of safety, when people have sort of given up on gold and gold companies, or the, you know, earnings are marginal and their balance sheets are starting to come under pressure. And that just buys us time now. So you've had this strong run up. Look, ironically, the gold price went up for reasons other than interest rates coming off. You know, obviously, a lot of speculation around whether that's Chinese buying of gold. We certainly don't have a strong view on that, but it did go up. And now the sort of momentum is behind those things. The interest is there. The companies are looking more expensive. We need gold prices to stay higher for longer to maintain those. And we're sort of looking the other way now. We're saying margin of safety is probably gone. And we're not getting out of them completely, but we're sort of less positive about them and easing our way out. I think we want to be dancing closer to the door for now. But yeah, those companies very hard. Gold in general and gold companies are very hard for us as fundamental investors.
Walter and Paul, if you maybe want to comment on that shortly as well, because
Sure.
Pierre did ask, you know, the views of all the managers. And I want to add to that. I mean, gold, Peter, you gave us a solid answer to that, but Walter and Paul, would you hold gold as a defensive asset if you want to go more defensive for whatever reason? Walter, if you want to give it a crack.
Sure. I mean, we've done quite a lot of work recently on gold and gold companies. So let me say this first. Research by one of the big banks in South Africa on asset class returns over time show that gold in rand is, over the long run, probably the second biggest contributor to asset class returns, just behind equities. And again, depending on how you slice it over time, you know, do you take the last 5 years, 10 years, 15 years? You can slice it many ways, but bottom line is gold in rand is a good contributor to returns for a South African investor. But it's not the gold companies. So similar to Peter, we have the same view that, and you can look at that over time. Company like Harmony doesn't make its cost of capital, continues to do rights issues to stay in business, and then you can just look at companies that was in the JSE in the 70s versus what's there now. These companies do not have longevity. So in our fund, we do hold gold commodity. Again, we're not trying to time things. We'll just have that there. And it's again, like if you unpack it, it's not the dollar price of gold, it's actually the rand price. So it's the ZAR. So it gives you like a currency, a currency kicker over time. If we own a gold company, it's more for risk and for hedging purposes. And so there is currently in the balanced fund and in all seasons there is some gold companies there, but it's not significant. 5% in the commodity and in the balance fund, and one company at 1.5%. All seasons would be probably, I think there's 2 companies there, 8% exposure.
Thanks, Walter. Paul, just Granout's views very quickly on this.
Yeah, we wouldn't have a specific view. I mean, a lot of sympathy with the idea of buying hard assets, but we try and buy hard assets that we can somehow put a value on. At the moment, we prefer West End properties in London. We think those are timeless hard assets. They're paying us a dividend. But yeah, it's just not within our area of expertise.
Paul, I want to stick to that because your man had actually your asset allocation very interesting. I want to get to local property as well, but while we're on lower property, you've got exceptionally high exposure to global property. If I remember right, sitting at about 11 to 12% in both your balance and flex mandates. We don't really see this in multi-asset mandates. Your specific views on global property, how does that get into the portfolio? And would it be fair to ask that you think that some of these specific counters you think will actually outperform some of your global equity counters?
Yeah, I mean, so our total exposure to property is about 18% in both those funds, of which, as you say, about 12 is offshore, and then 6% more or less is local.
Yeah.
I mean, property is no different to any other cyclical investment. It's a cyclical industry. And if you're going to invest in a cyclical industry, you've got to understand where you are in the cycle, more or less. If you get it more or less wrong, you lose a lot of money in a cyclical industry. If you get it more or less right, you can make a lot of money. Property is a long cycle, slow industry. And if you've got interest rates, for example, low for a long period of time, there are I suppose there are almost 4 factors at play. The one is there's a supply of money which results in building property at a positive margin. You can rent it out for higher than your cost of capital. The economy tends to be strong, so you've got good demand. Property values are being written up because there's good demand and that cost of capital is coming down. And then finally, when it's listed, the stock market loves it because now you've got this credible asset class that pays you a consistent dividend and it sort of goes up in a straight line. So you trade at a premium to book value. Even, I mean, in the height of this previous cycle, anything between 40 to 80% was quite normal. Now the cycle has turned and all those factors have worked against you. So property values have been written down, and on those written down values, the shares are trading at a call it half price of that. So as the cycle gradually turns, then you should get a write-up on your asset values. Your share price moves towards your asset value, and you're being paid a double-digit dividend yield at the moment. So for us, we're not in a very big hurry for this to work out because we're earning very good returns.
Very insightful. Walter, staying on property, yes, I think a lot of us broke our heads on property allocation in the past 5 years. It was a hyped up asset class, and then we all know what happened to local property. And I think a lot of us, if we look at SA property numbers over the past 12 months, I get a bit of FOMO there. Maybe we didn't have. You've got about 8% to SA property exposure, if I remember the number right. Your views on SA property, and again, similar to what Paul said, is that also just one of the asset classes you continuously watch to see where there's good value for investors?
Yeah, thanks, Eugene. Again, if you look at long-term asset performance studies in South Africa, property used to be quite a good contributor for all 4 down scenario. And yes, during that period, we did lower property exposure. It's sitting currently at 8% because we're starting to see some good value emerge, and actually the underlying conditions for some of these property companies are improving. You seeing less negative rental revisions, and in some instances, some companies are actually managing to increase rents. But it's typically not the biggest counters. So we're not in Growth Point. We're not in High Prop, where there's also quite a number of issues. So it's, you know, some of the counters that we're in has got some offshore exposure. So yeah, we're looking very specifically at where the fundamentals for these companies are turning or stabilizing, and invest on that basis. And yes, Vukile is one of the names that we own, and we own it across even our equity funds, because we believe that business is one of the few that has sorted out its fundamentals, and its underlying tenants are starting to be able to afford increasing in rentals, and not continuous repricing when contracts run out.
Again, companies specific or security specific, I don't want to make those calls. I'm going to give it to you so that you guys can make those tough decisions. Peter, I don't know if it's a crystal ball question or not, and I hate to do this to you, but we get a lot of it from investors and the audience as well, and it speaks to the US economy. And if we look at some of the big analyst companies out there, they certainly downgraded the possibility of a recession in the US specifically, but it's still there, it's still lurking. It's not something that's off the table. And what clients ask bluntly, and if you look at debt to GDP ratios in the US, but we know they've got a strong labor market to offset that, could we see another big pullback from US equities? Like I said, maybe a bit of a crystal ball answer, but what is your views on that? Can we still see a recession, a hard pullback?
Yeah, so I think, Eugene, I think there's two questions in that. The one is, can we see a pullback in US equities? Like, absolutely. That tends to be more sentiment driven, at least in the sort of short to medium term. And then the other one, can we see a recession in the US? Of course, it's always possible to have a recession. I think, you alluded to the fact that economists were thinking that was coming last year, and then it just
exactly.
Now they've sort of, I guess, once bitten, twice shy. Now they're saying it's not coming anymore. Of course, it'll come at some point. I think that's just the way the US economy works. It tends to kind of grow hard, probably go a little bit too far, and then come crashing down in a quick reset, and off we go again. So you can rest assured there will be a recession at some point. The timing of it is anyone's game. These sort of overshoots tend to longer than anybody expects them to do. At the moment, the consumer is very well employed. Their wage growth is pretty good. They're still sitting on decent savings, partially as a result of all the fiscal stimulus that got thrown at them during COVID. So the consumer, which is the driver of the US economy, is still in great shape, and that momentum is still pretty strong. So it doesn't seem like it's imminent. And recessions always come out of something that it's usually debt focused. So there's a pocket of debt that's built up that we've all kind of ignored for too long. And that all comes tumbling down. We're not going to try and predict where the next one comes from. But yeah, I think in general, kind of waiting for US recessions has probably cost people more money than it's made them. The 2 or 3 years out of the market waiting for the recession is probably more expensive than riding your investments through a recession in the US. So we're not terribly focused on that. Of course, it's possible. But it's not something that keeps us awake at night.
Yeah. James, thank you for that. I just want to step off from growth assets very, very quickly. In a multi-asset mandate, we all obviously know there's a big fixed income component. All three businesses have very strong fixed income capabilities. We've seen it illustrated through time. But I just want to check your views very, very quickly on that fixed income component. again, the bell on SA nominal bonds has been rang so many times over the past 18 months. And of late, we've also seen, a bit of an uptick in bond yields, so volatility coming through there. Your fixed income component, does it lean more to fixed rate notes or nominal bonds, or does it still lean more to floating rate notes? Peter, I don't know if you want to start with that, then Walter and Paul, I don't know if you want to comment on that.
Yeah, I think we've probably lent a bit hard into the fixed rate nominal bonds, which has been a pretty disappointing journey.
Yes.
I think, for a couple of reasons. I think a lot of that has to do with the fact that we're kind of now in a higher for longer environment offshore, and we're kind of that filters through into here, into South Africa. We've more recently had a bit of SA specific selling, which has hurt that. And over the last couple of years, we've had a number of kind of more domestic related issues, the downgrades, things like that have been a bit of a headwind to that. But at some point, 12% on a South African 10-year bond when our inflation is at 5%, when we're shooting for 4% real growth for investors, it's hard to ignore, particularly if you've got a long-term view. So, in the short-term sentiment and high interest rates offshore are going to maybe provide a headwind for that. But ultimately, we think all of that stuff will normalize. There's a lot, our credit spreads are pretty high. There's a lot of bad news already in the price, and so it's been a disappointing journey leading into nominal bonds for the last few years, but we think now is probably not the time to capitulate on that.
Thanks, Pete. Walter, if you want to jump in on that.
Sure. I mean, our views is probably pretty much as Peter has described it there. So we're sitting in SA government bonds. Like really never understood this negative bond yields that you got out of the developed markets. And yes, you're being paid a decent yield on an SA government bond that you can't really replicate elsewhere in excess of inflation. So similarly, we don't feel it's time to capitulate on that.
Yeah, I think we all have those views. Paul, we've recently seen comments from Bronwyn coming through as well. And I mean, that's part of your team, part of a fixed income component in the portfolio. So I'm not going to elaborate on that. Maybe very, very last question. And it also speaks to some of your global allocation, more specifically, the rest of the world. We spoke a lot about the US and opportunities in the US, and Walter, I know you've got very strong views on a lot of those opportunities in the US, the Magnificent Seven, and you've mentioned a couple of them. But what about the rest of the world, and more specifically emerging markets? Is that something that you actually look at? Paul, if you want to maybe give that a crack, or for your global component, you just stick to developed markets because that's where the true shiners are.
Yeah, I mean, for us, emerging markets are very hard. You can be very right on your stocks and then ultimately very wrong on some tsunami that hits you from Westfield. So we don't really try and get too deeply into the emerging market opportunities outside of South Africa. But I mean, in terms of where the opportunities are, we've recently started looking at a list of European mid-caps, and I mean, they're fantastic businesses that you actually can't believe the value. So in the UK also, even not only the property, there's industrial stocks that we own, a very good industrial stock, and the valuations are sometimes similar to the African valuations. So there really are good opportunities around. The high interest rate environment has resulted in cheap stocks. It's just not evident when you look at the big US names.
I feel you on that comment on emerging markets coming from the side. Peter, Walter, your comments, rest of the world, not necessarily emerging markets.
Sure.
Yeah.
Peter, you want to go?
Yeah, I'll have a crack. So we do have a team in London that look at emerging market ex-SA stocks. We tend not to put that stuff into our managed fund specifically, just because we think you've got plenty of emerging markets exposure via SA in there.
Right.
And you know, even within SA, you've got kind of exposure to China and other things. So for this particular mandate, not a huge focus for us, but having the expertise in looking at emerging markets and understanding sort of a psyche of management teams in emerging markets, we think it's helpful to look at those companies. But as I say, we tend not to add to the emerging market exposure we already have in this particular mandate, unless there's, you know, really phenomenal sort of standout companies. Yeah, we would generally have a low SA-EM exposure in the mandate.
Peter, I mean, adding to that, you've already had a good offshore team, and you've recently added to that. So expanding on offshore capabilities. So interesting things happening at Anchor. I'm going to park it there, Walter. Rest of the world, or you stick to
Sure.
the base?
Yeah, I mean, let me quote something that Richard Pitt often says. We don't want to be at an information disadvantage when we invest. So we tend to stick to developed. There's good governance, strong market rules as to disclosures, etc., etc. In emerging markets, these things are not always as transparent. You know, in some of these markets, you know, we don't even speak the language, etc., etc. And people will often say, you know, can you manage offshore money from South Africa? Yes, you can manage offshore money from South Africa in the right markets where governance applies, the market rules are the same for everybody, and you're not at a disadvantage sitting at a distant location. So we stick to the developed markets where we know we can trust the governance and the rule of law.
Gentlemen, thank you very much for that. I'm going to hit the pause button, and I say the pause button because we're going to hear a little bit more of all of you in the upcoming BCI Global Investment Conference as we unpack a little bit more in what you had to say. I do want to apologize to our audience. I'm very naughty with panel discussions, but there's so much to cover, and it's really, really good information coming through from our panelists this morning. To Paul, Bosman, Peter, and Walter, thank you so much for joining us this morning. It's been extremely insightful. Your flexible multi-asset capabilities, we know it's right up there. To our audience, if you don't want to make those calls, you've seen now a little bit of insight as to what they do in their multi-asset mandates, and they've got a couple of other mandates as well, other than the balanced mandates. Again, thank you for your time this morning and all the insights that you share with us, the good work that you do for our clients. We're really grateful for that. To our audience, quick reminder, next week, Wednesday, it's a public holiday. So I'm going to miss you, Novatix on Wednesdays. But I'm looking forward to seeing all of you at the BCI Global Investment Conference. As I mentioned, 6-7 May live in Cape Town. Some of you are attending online, but it's going to be great to see you there in person as well. Give you time to have those intimate discussions with our portfolio managers. And then the 8th of May will be online with our global managers stretching right across the globe. It's going to prove to be very interesting. Gentlemen, again, thank you from our side this time. To our audience from the BCI team, thank you for your continued support. We remain grateful. And I'll speak to you soon. Keep well.